Welcome to the August 24th, 2020 Nichols Tax Update Podcast. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I acknowledge the value of my subscription to Tax Notes Today, the preeminent source of information for tax professionals in preparation of this program. Here's what's in this edition. Court decision that vacation property did not qualify as a rental activity. That's give us some additional information on the application of Code Section 469. And then a technical point, an extended period to roll over a qualified plan loan offset amounts. We'll talk about what a qualified plan loan is and how it differs from a plan loan. Then I have the applicable federal interest rates for September. I think you'll be interested in those. I know that they're probably not, well, I think they're at historic lows, but they might not be any lower than the preceding month. In any event, then we have a deduction allowed for charitable contribution of real property. A real estate developer gave the township some acreage about the same time the township approved his application for real estate development. Suspicious circumstances, right? Not so, said the court. Now, tax return preparers must have a plan for data protection, including reporting any theft of data. That's the IRS reminding us that federal law requires us to have a written plan for data protection. And then 2 IRS practice units. These are slideshows that the IRS prepares to train their agents on parts of the tax law. We can download them, we can convert them to their PDF documents, we can convert them to PowerPoints, we can use them for staff training in our firms. I may decide to use excerpts from some of that in our tax updates this fall. And then what happens when a carried interest is transferred? We've had all this sturm and drang on carried interest and the fact that promoters get capital gain for what really should be ordinary income. And we got final regulations. Pretty well cleaned the subject up, but there's always 1 or 2 little topics that are left over. Finally, we get a look at the new Form 1040. And it's not getting any smaller. It's not getting any less complex. It's nowhere near a postcard, and it has 3 new lines. Well, let's start with the vacation property that did not qualify as a rental activity. Greg Egger, a decision of the 9th Circuit, taxpayers could not treat rental of 3 vacation properties in California as rental activity qualifying for special loss allowance under Code Section 469. They would have been allowed to claim up to $25,000 of a rental loss where the rental activities are by definition passive, but if you're under certain income limits and you can claim, and if you have a rental activity, you can claim up to $25,000 loss. The problem is they had a management company managing these properties, and they argued that the management company was the customer, that the property was rented for the entire year. No, the properties were rented by the week to customers. The circuit court had no trouble plowing through that. The management company was simply the owner's representative. So the average period of stay was not greater than 7 days. Taxpayers then must treat rentals as a trade or business. What happens to that? Well, it's a trade or business in which they did not participate, from which they have a passive activity loss and no deduction. Next, qualified plan loan offset amounts, QPLOs. The recent economic ups and downs have caused some individuals to lose their jobs, not through any fault of their own, but the employer shut down or they downsized. A qualified plan loan offset is a plan loan that is deemed distributed because there is a termination of employment. So a qualified plan loan offset must meet 2 requirements. It must be treated as distributed solely by reason of termination of the employer's plan or severance from employment of the employee. The plan loan offset amount must relate to a loan that met the requirements of Code Section 72P2 immediately before the termination event, and that was it was under the loan limit. It required a 5-year level amortization repayment. What this does is it gives the employee who did not terminate their own employment, but whose employment was terminated, either by the plan being terminated or their employment being terminated, at a time when they had borrowed money from their qualified plan. Without this rule, they have to roll that loan over. The loan is a deemed distribution, and they have to roll it over within 60 days. The qualified plan loan offset amounts give the employee until the day they file their tax return for the year plus 6 months. It's a very interesting proposed regulation. Great reading for any of you that have clients whose employment was terminated through no fault of their own at a time when they had a plan loan in 2020, and you're going to be faced with the 60-day rollover, or you can claim the relief of the qualified plan loan offset. Applicable federal rates for September 2020. I remember the Carter administration. I remember interest rates of 12 and 14%. This is crazy. Revenue Ruling 2020-16, applicable federal rates for transactions closed in September of 2020. The applicable federal rate for a loan term of 35 months or less is 0.14%. That's 0.0014. For 120 months or more, it's just a flat 1%. That's 0.01. These are historic low rates, and here's why I'm bringing it up. Families with intra-family loans and businesses with loans that are taxable under Code Section 7872 should consider renegotiating terms of those loans if interest is not a factor with the lending side of the deal. In other words, if I didn't loan you the money because I was looking to make money with the interest, but I loaned you the money so you could take advantage of an opportunity, or I loaned you the money because you're my son-in-law and I want my daughter to have a nice house, we can, and maybe 3 or 4 years ago the interest rates were higher, renegotiate that loan, knock that interest rate down. It's probably not going to get any lower than this. It's a wonderful opportunity to do some tax planning with debt. Now, good news. We can file some 1040Xs electronically, not all. Information Release 2020-182. Taxpayers can now file Form 1040X, amended U.S. individual income tax return, electronically. The headline blared. But wait, before you start the celebration, read on. For the initial phase, only tax year 2019 Forms 1040 and 1040 SR, that's the one that they've designed just for people like me that are over 55, those are the only returns that can be amended electronically. So it's not the great breakthrough that it is initially heralded to be. Here is a classic. I want you to, if you have real estate developers, if you've thought about what to do when a real estate developer contributes property to a township or to a government authority, here, this TC memo, although it's not citable as strong authority, it does give you a little insight into how you might make your arguments. This is Peter C. Emanuel. Emanuel, I think that's how you pronounce that. It's Emanuel. It's not our classic spelling and pronunciation, but I believe this is Peter Emanuel. TC Memo 2020-120 on August the 17th. Here, Mr. and Mrs. Emanuel are entitled to claim a charitable contribution deduction for property he donated to a town. It's a 35-page opinion, a wonderful teaching case in which the court carefully analyzes all of the circumstances in the negotiation that went on between Mr. Emanuel and the township over a period of a decade. He originally bought the property in 1999. We're talking about this gift in almost over a decade later, and we're still litigating it 2 decades later. So Mr. Emanuel, I know, is going to be glad to, hopefully he puts a nail in the coffin on this one. So the taxpayers are entitled to claim a significant charitable contribution deduction. This tax court memo decision deals with the carry forward. The IRS missed the statute on the year in which they claimed the deduction, but they swooped in on the taxpayer's attempt to use the carry forward. So is the carry forward good? The court says they substantially complied with qualified appraisal requirements in Section 170. They filed the Form 8283, but the appraisal lacked 2 statements. It lacked a statement on the expected date of contribution, but the court said that's not a problem. The contribution was made within 30 days of the date on the appraisal. And then there was no statement of what the appraisal was for. The court said that's not a problem. The appraiser stated that the appraiser was for a disposal of the property. You don't have to say that it is for income tax purposes, according to the tax court in Peter C. Emanuel. The contributions were not part of a quid pro quo exchange. The fair market values they claimed were correct. The husband's a real estate developer. He gave property to the township. He got approval for his project. Boy, that sounds suspicious, right? Well, he acquired land and first proposed a development in 1999. Over the next 9 years, Mr. Emanuel and the township went back and forth, back and forth. He would propose a modification. The township would lead him to believe it was going to be approved. Then they would not approve it at the final meeting. Setting aside some land was always part of the negotiation that stretched over 9 years. The land which is the subject of this litigation was donated after a downsized version of the original plan was finally adopted, and the township got the land that was originally proposed in that plan, that development plan. The land that is the subject of this charitable contribution was extra land, not part of a quid pro quo. Well, I can. It just takes a lot of effort. Where is your data protection plan, children? Do you know where your data protection plan is? Information Release 2020-184. You must have a plan for data protection and for reporting theft of data. Federal law requires you to have a written information security plan, and the agency recommends that you also create an emergency response plan. You see those written in italics. A security plan and an emergency response plan should you experience a data theft. Those are basic security steps for all practitioners, but especially if you are working remotely or social distancing. If you are working from home and your internet connection may not be as secure or as well regulated as the one you usually have at the office, you need to do something about improving the internet connection and getting a written data protection plan. LIFO pooling. Here's a training tool available. You say, wait a minute, Nichols. What LIFO? What are you talking about LIFO? I'll tell you in a minute. IRS has released a practice unit, which, as I told you at the beginning of the show, is a training slideshow on the last in, first out inventory method pooling rules, which differ by method and type of business, but knowledge about LIFO pooling would be very useful if we were going to adopt LIFO for an inventory or two. But why any interest in some of the fine points of LIFO? Well, what are you observing in current national finance? Has our government been printing money? Are we running tremendous deficits? Isn't that the classic setup for inflation? The IRS has been here before. They can feel the forces at work in our economy that are going to fuel inflation and make LIFO more attractive, and they want to get their agents trained ahead of the curve. You heard it first here. Next, a training tool on S corporation distributions. And it's kind of interesting the way the IRS writes up the description. They have a practice unit that focuses on the taxability of distributions from an S corporation that either does not have accumulated earnings and profits or makes distributions from sources other than accumulated E&P. Well, an S corporation will have earnings and profits or accumulated E&P only when it operates as a C corporation. When it operates as an S corporation, any income that it holds on to in the corporation is going to be in the accumulated adjustments account. In short, this training tool is about an S corporation that makes distributions not taxable as dividends, but the distributions are made from its accumulated adjustments account, its AAA. Those are going to be tax-free to the shareholder so long as the shareholder has basis. And that's the IRS interest. This is the other leg of the IRS's strong interest in partnerships tax basis capital. The IRS has come to understand from their examinations that partners and S corporation shareholders are not appropriately tracking their basis, so that they are claiming losses when they have no basis, or they are not appropriately tracking the S corporation's accumulated adjustments account. That's it. S shareholders have not done a good job of tracking their S corporation stock basis, and the IRS, once again, is training their agents to catch that particular breach of the law. The carried interest rules. Oh boy, you know, you had to have really sophisticated clients, and they had to be all kinds of fancy deals where they helped form a partnership and they got a carried interest, and the partnership was going to have capital gain, and the carried interest partner got capital gain as consideration for all the work they did, and it should have been ordinary income. That's the background. In Tax Notes Today on August 21st this year, in an article by Eric Yauch, he analyzes one last piece that the high-powered tax planners are worried about with regard to carried interest rules. We know that any transfer of a carried interest is a realization event, even to a related party, and that's to be avoided at all cost. But there is one exception for transferring my carried interest, and that is to a grantor trust. The grantor trust is a disregarded entity. I'm effectively transferring my carried interest to myself. That's okay. But that does not cover every base. What happens, advanced planners are worried about, when the transfer goes the other way? When a grantor trust terminates its status and transfers title in the carried interest back to the grantor, is that going to be a realization event? Or is the IRS going to carve out another exception to application of the carried interest rule? Finally this week, the draft Form 1040, 3 new lines, no simplification, nowhere closer to a postcard, out as of August 21st. 36 lines on the basic form, plus several schedules for special situations. Then there are these 3 new lines. The first, you have to report activity involving virtual currency, any activity at all. If you touched Bitcoin or Whizcoin or any virtual currency, you have to report that right near the top of page 1 of your Form 1040. Claiming charitable contributions, if your taxpayer takes the standard deduction, is also on page 1 of the Form 1040. And then on page 2, we have a new line for claiming the recovery rebate credit, obviously something that is related to COVID-19. Well, folks, that's a wrap. I really enjoyed putting this program together. You may have noticed there are more topics than we had last week. Some weeks are like that. Sometimes it's diamond, sometimes it's stone. Thank you so much. Until next week, I'm Lynn Nichols, and signing off for the Nichols Tax Consulting Group and the South Carolina Association of CPAs.